Good evening once again, and thank you so much for logging into the monthly webinar of Ambit Asset Management. We have with us today Mr. Bhargav Buddhadev, who is the portfolio manager for Ambit Micro Marvels portfolio and also co-manages Ambit Emerging Giant Small Cap portfolio. Uh, Bhargav comes with more than 2 decades of experience in the investment industry and has been part of Ambit Asset Management since the last 2 years now. We will cover the portfolio performance and the newsletter that we have written on the chemical sector and the reborn of this particular sector. And we will cover in detail in terms of the market tailwinds that we have witnessed. Bhargav sir, over to you.
Yeah. Thank you, Sahil, and good afternoon, folks, for joining our monthly webinar. Let's kickstart with the portfolio performance. Yeah, so if you look at Ambit Coffee Can in the month of June, the portfolio did fairly well with a return of about 5.4%. For 3 months as well, the return has been almost 11.2. The top performers have been KFIN, About India, Interglobe. And if you look at the bottom performance, it was primarily Bajaj Auto, Pidilite, and ZF. Moving on to Good and Clean. So it was a good month for Good and Clean as well. So if you look at the monthly returns, the portfolio did return close to about 4.3% in terms of returns. The top performers were AU Small Finance Bank, Timken, and Emphasis. And if you look at the bottom performance, it was IGI, Deepak Nitrite, and Aegis Logistics. In terms of emerging giants, so obviously last couple of years have been a bit difficult in terms of return generation. But if you look at the last 3 months, emerging giants has come up fairly strongly. So if you look at the last 3 months returns, it was closer to about 23% versus 10.7% for the benchmark. For the month, it has clocked in about 3% returns. If you look at the top performers, they were Alkylamines, AU Small Finance Bank, VIP. And in terms of the bottom performance was from Prudent, CCL Products, and Venus Pipes. Coming on to 10x, the 1 month return has been closer to 2.4. 3 month there has been an outperformance with about 11.2% return. The top contributors being AU Small Finance Bank, Aditya Birla Real Estate, and Orchid Pharma. And if you look at the bottom performers, those were the Prudent, Mrs. Bector's Food, and CCL Products. And lastly, coming on to Micro Marvels, so Micro Marvels also has now made a good comeback with a 1 month return of about 4.5 and a 3 month return of about 15.6 as compared to 10% benchmark. The top performers for the month of June were Food and Ins, Insecticides India, and Control Print. And the bottom performers were Khadim, Tejo, and Bajaj Healthcare. So let's move on to the main agenda of the newsletter, which is the chemical sector. So we deliberately chose to write on this sector, given that we have been meeting a lot of companies in the chemical sector in the last 3 months, and we have been doing a lot of channel checks. In fact, across our portfolios, we've taken very aggressive bets in chemicals. So we thought that it's best to sort of give a complete deep dive in terms of why we are turning very positive on the sector. So let's kickstart with a few of the highlights of the newsletter. So as you already know that during FY21 to 23, which was the golden period for chemical companies, the sector did extremely well. And a few of the reasons why the sector did very well was obviously the COVID-led disruption. So if you look at the second chart, the second top chart on the right-hand side, during COVID, the freight rates obviously went up significantly. You can see the arrow pointing upwards towards the tall tower. So, because of the rising international freight rates, obviously, what a lot of channel partners, primarily distributors, did was they started restocking. If the inventory levels are 100, it actually went up to 150 odd. There was a significant increase in terms of inventory during this COVID period because people were not very clued up in terms of what supply chain bottlenecks they could face. So, resultantly, if you look at the first chart on the top left hand side, you can see that the inventory levels actually started rising. So the mountain thing, which you can see on the first chart on the left hand side, clearly shows that the restocking started happening. Resultantly, if you look at the second chart on the left hand side bottom, you can clearly see that across various subsectors of chemicals, which is commodity chemical, specialty chemical, agrochemical, all the various subsectors started reporting extremely strong growth. And as a result, obviously, there was an exceptional rally as far as the specialty chemicals is concerned. Just to sum up this slide, COVID led to significant increase in freight rates. Significant increase in freight rates led to higher inventory stocking, and obviously higher inventory stocking meant a lot of demand for chemical companies, which you can see that the same flow through in terms of very strong revenue, EBITDA, and PAT growth. If we move on to the next slide, obviously what analysts across the street started doing is extrapolating. So what they started doing is that the strong performance which was there during FY21 to 23, they started extrapolating that to FY23 to 25 period. So if you look at the first chart on the left hand side, you can see the estimates that people started building in very strong revenue growth, very strong EBITDA growth, very strong PAT growth, even for FY24 and 25. In fact, if you look at the chart on the right hand side, you can see that during post the bull period, there was significant upgrades in the chemical sector, with almost 73% of the analysts putting in buys for the chemical sector. So typically, what happens is that whenever there is a euphoria, that also further gets extrapolated into the future. And people sort of become extremely positive once they see that the cycle is doing well. And that is what actually happened at the end of FY23, wherein there was significant bullish estimates for 23 to 25 period. If we move on to the next slide, however, what happened was that that optimism actually did not translate into actual picture. So, if we look at since FY23, you can see that the inventory levels actually started dropping down, and the main reason for that is that COVID actually sort of peaked during 23, and post that COVID actually evaporated. So resultantly what happened was that there was a significant decline in crude oil price, there was a significant decline in terms of international freight rates, supply chain actually became fairly normal, and resultantly, a lot of companies as well as channel partners said that there is no need to overstock. So actually, the channel went through a reverse cycle wherein the inventory started getting destocked. So on the top left hand side, you can see 1.73 levels actually falling down to about 1.63. So what we are trying to highlight is that whatever optimism was there during the COVID period actually reversed during FY23 to 25. And if you look at the chart on the left hand side, the bottom chart on the left hand side, you can see that chemical companies started reporting very poor numbers during 23 to 25. Not only was there volume disappointment, but also realizations started to sort of decline because the demand virtually evaporated. And if you see the last chart, which is the chart on the right hand side, you can see that even institutional ownership started reducing during calendar year 2023. The FII shareholding across chemical companies actually declined from 7.4 to 6.9. So net net, what we are trying to highlight is that 23 to 25 period was a very tough period for chemical sector in general. And primarily the reason was the performance. The fundamental performance started deteriorating as there was widespread destocking which happened. And also with crude price falling, chemical companies had to pass on the benefits of raw material cooling off, and resultantly there was a pricing pressure as well. Obviously, what is the picture now? If you look at the picture from now onwards, what we are saying is that if you look at the chart on the left hand side, you can see some improvement as far as inventory restocking is concerned since the month of Jan 2025. So, what does this data indicate? This data indicates that since January 25, which is in the last 6 months, the channel has again started restocking. And what that has done is, if you look at the second chart on the top, which is on the right hand side, you can clearly see that in 2025, things have actually started improving as far as the production is concerned. Meaning, what we are trying to highlight is that in the last 2 years, the revenue growth and the volume growth was declining. But if you look at the 2025 year, the volumes have now started flattening out, and the pricing has also now started flattening out. In fact, if you look at the last chart, which is the second chart on the right hand side, you can clearly see that there are early signs of companies also announcing capex. And the reason for that is that not only there is inventory restocking which is happening, but there are other opportunities also in the chemical space which are emerging, led by import substitution, CDMO, and exports. So clearly, we are seeing some early signs that the sector is trying to make a comeback. Next slide. Yes. So, what is this going to lead to sort of fundamentals? So, if you look at free cash flow, so at Ambit we play a lot of importance to free cash flow. So, if we were to extrapolate the free cash flow as far as our estimates are concerned, which is our in-house estimates, we are actually building a very positive scenario on free cash flow. And the reason for that is that in the last cycle, which is 21 to 23, a lot of capex was incurred. There was a lot of capacity which was built up during the COVID period. Unfortunately, during 23 to 25, the utilization levels decreased. So now what is happening is that there is enough capacity for the next 1.5 years for the sector to reach peak utilization, which means that as the revenue growth starts to incur over the next 2 years with very small capex, you could actually see a very strong free cash flow generation. So if you look at the chart on the first chart on the left hand side, you can clearly see that across commodity chemicals, specialty chemical, agrochemical, and in total, we are estimating a significant recovery as far as free cash flows is concerned. In fact, the free cash flow from a 76 billion is actually going to increase to about 108 billion. So there is a significant improvement as far as free cash flow is concerned. If you look at the second chart, on the top second chart on the right hand side, you can clearly see a very strong free cash flow yields across the chemical subsectors. So in commodity chemicals, we are seeing companies which are available at upwards of 5% free cash flow yield. In agrochemical, we are getting companies upwards of two times the free cash flow yield. And even in specialty, we are seeing upwards of 0.5 times the free cash flow yield. So net, what we are trying to highlight is that there is enough comfort on valuations, given that free cash flow yield in chemicals across commodities and agrochemicals in particular is actually upwards of 2.5%, which means that there is limited downside from here on. In fact, if you look at even price to earnings and EV EBITDA, you can see that across commodities, specialty, and agrochemical, the valuation multiples are also now very reasonable, with the range being around 27 to 25. So between 25 to 27 P, you are getting specialty chemical stocks, and in fact, we've to still not built very optimistic 27 assumptions in terms of recovery. If we were to build in very optimistic numbers on recovery, then most of the chemical companies will actually be available in the range of about 18 to 22 times FY27 earnings. Moving on. This is the proof of the pudding. So if you look at last 6 quarters across domestic institutional investors and across foreign institutional investors, we are seeing a very good built up in terms of shareholding. So across the various chemical companies, we are seeing ownership increasing. In fact, in few companies, there is almost a 10 percentage points increase as far as domestic shareholding is concerned. And as far as foreign shareholding is concerned, again, there is a significant interest which is getting generated, with a few companies seeing almost 2 to 3 percentage points increase in terms of foreign shareholding. So what we are trying to highlight is that the smart investors, which is the institutional investors, which obviously do a lot of research, they have started building in a lot of positions in chemical sectors, and this is across domestic as well as foreign shareholding. In fact, if you look at the bottom chart, you can see that the same behavior was being seen in auto and capital goods during the 2022 and 2024 period. And post that, obviously, the sector actually started doing well. In fact, in 23 and 24, both the auto and capital good companies did extremely well in terms of performance. So what we are trying to highlight is that we are seeing early signs of institutional interest getting built up across various chemicals. And it's not that it's happening only across commodity, but it's happening across specialty, it's happening across agro. So clearly we are becoming very, very bullish on the sector across all our strategies: large cap, mid cap, small cap, micro cap. We are getting overweight on the sector. And just to conclude, in terms of our thesis, we are seeing a very strong volume growth recovery led by both channel restocking as well as opportunities emerging in terms of import substitution, CDMO, etc., etc. Also, we are sort of seeing muted capex over the next 1.5 years, which means that the recovery in terms of volume is going to translate into free cash. And lastly, we believe that valuations are fairly comforting. If you look at the universe of stocks, there are very few sectors which are likely to report 15 to 20% earnings growth over the next 2 years, and we believe chemicals is one of that sector. So that's one of our biggest reasons why we are sort of extremely bullish. Obviously, if you want more details, you can go through our newsletter. We've written a fairly detailed newsletter. These were a few of the interesting aspects from the newsletter which we thought to put up in the PPT. But happy to answer any questions you have when we go to the Q&A session. So now coming to macro and market update. Tilok will take up the macro and market update.
Hi, good evening. Welcome, and I will take you through what's happening across the world, both in India and the world. Moving ahead, I think so. One of the most important point that we had discussed even earlier is about how the dollar devaluation will impact the markets both in India and globally. We think, and we have obviously showcased various scenarios in the past as well, whether it's 2003, 2007, or being the latest history, or even in 2019 and 2020. Usually devaluation of dollars has been a great sort of news for emerging market in totality, and you will be obviously very happy to learn this, that Indian markets in particular have done exceptionally well during this devaluation period, because within emerging markets, India stands out in terms of growth rates, and also is amongst the best ROE market in the world as we speak in emerging markets. Coming from what's happening from devaluation to what the what's happening in the country, so we have seen that the monsoon has progressed very well in the last few weeks, and we are running ahead across the region. That's a very good sign for rural market in particular. A, inflation is under control. B, sowing season has been very strong. And C, rural wage inflation is actually in positive digit compared to what RBI was thinking. Which is why if you look at the overall sowing data, it's obviously up in double digits. And by the end of this particular monsoon season, we think the kharif crops will actually see a mid to high single digit sowing, which essentially is the great news for agri output as in totality. Moving ahead, when we look about what's the consumption pattern that we are thinking, we are very clear that rural is seeing positive signs of wage growth after 2.5 years of negative wage inflation, and here we are talking about real wage inflation. So real wage inflation this is the second consecutive year where you will see a very positive sort of outlook going forward. Moreover, the consumption pattern of urban outperforming rural, in our opinion, has narrowed down significantly, and we think it could well be rural outperforming urban in the next few weeks or next few months to come by. Particularly with good monsoon, good agricultural output, and wage inflation positive, is a good sign that where we think the market will be very enthused upon a rural recovery, which is long pending in the last 2-3 years time frame. Moving ahead, what's happening in the earning growth, because now we already had the season with a couple of IT companies already reporting results. So IT companies so far have reported in line or marginally ahead of results in expectations, particularly on the profitability front. In revenue front, there are obviously a mixed bag if you look at various IT companies. But if you look at the broader earnings estimates, Nifty will probably deliver a 5% earning growth this quarter, which is uptick compared to last quarter. But we have obviously expecting a single digit growth only, and when compared to mid and small cap space, earnings will also be very limited to certain pockets. Also, please bear in mind this particular quarter will be impacted because of uncertainty of Trump and tariff, which got announced between April and June. And the biggest driver for the growth in this quarter will be a few sectors, which is telecom and commodities and so on and so forth. Moving ahead on market valuations, if you look at the market valuations, is obviously are marginally above long-term averages in terms of P multiple. Our belief is this P multiple could well get sustained because of abundant liquidity in the market. But more importantly, the price to book earnings will actually is at higher levels because of better ROE compared to on history. In that context, we really believe that the earnings growth going forward will be very polarized in a few segments and few companies. A broad-based earning growth of FY22 to 25 will not repeat in 26 and 27, which is why bottom-up approach, investing in quality and investing in good businesses will remain the epicenter, and FY26 and beyond will be in a stock picker market compared to a broad-based market that we saw in FY24 and 25.